Alright, so today we're going to go over the homework, which we've completed chapter 8 on Tuesday. So we'll go over each of the homework problems, and for those that happen to come to this one, you get to know it right off the hand and can ask any questions you have. For those that end up watching it later, and if you have questions, email me or send me a reminder, or even comment on the YouTube video if you go to that video. Either way, I'll be able to get a hold of you. Alright, so starting off with problem number 1. This is dealing with, looks like white top flagpoles, and they're going to have an accounts receivable of a certain amount. This one has $29,000. An allowance for bad debt has a credit balance of $4,000. During the year, rank top flagpoles record the following. And of course, we have the requirements. So we can click here. And then the information also right here. But it's going to give us this through these requirements as so. So, requirement number 1, we need to record the sales transaction that ends up happening. We're going to ignore cost of goods sold for this one. And we're going to go ahead and record the sales. Now remember, it's telling you to do it as a single compound journal entry. And the reason why is because their sales is mixed into 2 parts. Their credit sales and their cash sales. So, journal entry, of course, when cash, and that is a debit. But again, it increases by a debit. And then, since we're selling on account, look at this, we're expected to receive cash. But since we haven't received them, that's a debit to accounts receivable. Okay. Now, our credit would be sales revenue because it is sales. It happens to be of $180 for me. And of course, they want to record sales for the year. And that, because that's the requirement, go ahead and check, and everything should be good. And this is again known as a compound when we have more than 2 entries. Okay. Next, we have to journalize the collection on account. Okay, so basically we collected so many of the accounts receivable during the year. So, when it's a collection, we know it's cash, and we know it's going to be a credit to accounts receivable. Basically, they paid off their bills. 138, 123. There we go. Again, we're going to check. I keep again those explanations. And collected cash on account. There we go. So, there's 2. I remember those explanations. I typically forget about those. Technically, in the real world, we don't really do them. Just for Pearson, you like it. Alright. Next, we wrote off uncollectible receivables. Now, this we have to check on. Since we can tell that they have allowance for bad debts, This is not a direct write-off. This is an allowance method. So with that, we are going to have to put allowance for bad debt as our write-off account, because it's an allowance method. I'm going to try and get you with having bad debt expense. But since we're not doing direct write-off, we're only doing the allowance method, this is our debit. Then, of course, since we're writing off these uncollectibles, accounts receivable is going to be credited to show that we basically got rid of these accounts that will not be collectible on, or collected on. So 2,600, 2,600. Oh. Okay. And of course, explanation, because if we forget those, get yelled at by the computer. There we go. Alright. Now we're on required 2. I'm going to actually close this since basically it's simple what the requirements are. Post writes transactions to accounts receivable and allowance for bad debt to accounts. Enter the beginning balances and the journal entries, and then compute the unadjusted balance of each account. Okay. So, January 1st balance, we find up here, happens to be $29,000 and $4,000. It's a credit balance. Get that note scroll up. So, January 1st, I had $29,000 of receivables. Okay. Allowance for bad debts. I had a credit. So that should be on the credit side. Boom. That's 4,000. Okay. Since we're in this like truncated space, we have to basically go line by line, use the blanks that we can. And that's mostly due to the accounts receivable. So here, we have additional credit sales. Our debit sales, credit sales, that's a debit of $159,000. So that's net credit sales. Next journal entry, we have collections. So they get credited to 138. That's our collections. And then looks like the last journal entry, we have the write-off. So 2,600 credit, write-off. Here for allowance, the only other journal entry that has allowance is the third one, for the write-off. The write-offs of 2,600. Next, we just need to find the unadjusted balance. Of course, I know for accounts receivable, it should be a debit. Well, allowance is going to be a credit. Then which one's higher? So let's take out a calculator. And figure all this out. Alright. So for accounts receivable, we have 29,000 plus 159 our debit. Then subtract out our credits. Okay. So accounts receivable for me should be 47,400. Remember, your guys' numbers will be a little bit different, but the process is the same. So again, allowance for bad debt, it's a natural credit, so credits are positives. All debits will bring it down. Okay. So we have 1,400 for our allowance for bad debts. Okay. Check. We're good to go. Again, if you have any questions while I'm going through, please let me know in the chat window. Okay? Alright. Required 3. This is a long problem. We'll have to say that, but we only have 2 parts remaining. Alright. Journalize rights adjustment to record bad debt expense. Assuming right estimates bad debts as 1% of credit sales. Post of adjustment to appropriate T accounts. We don't have T accounts right now. But this is our journal entry for, again, when we do under the allowance method, we estimate always bad debt expense and allowance for bad debts. Next, you need to figure out credit sales, which again, you can find this journal entry, or when they say on account, so it's $159,000. Let me put that in, times our percentage, which was 1%. Okay. So for me, my adjustment of uncollectible based on credit sales. Remember, credit sales, when sales percentage of sales, does not matter what's in allowance for doubtful or allowance for bad debt. Okay? All it does is basically, once you do multiplication, that's your number. 1,590. Okay? Oh, I forget that explanation again. First, that explanation. There we go. Recording bad debts for the period. Okay. Now I like how you can see your homework score. Actually lets us know how much of the homework we have to do. Especially if we're getting everything right. Alright. Now, we do get to enter in the journal entries. Okay? So one, you shouldn't have anything in the accounts receivable. That one's done. Okay? For this, we would have to take allowance for bad debt. That's going to get credit of $1,590. So we'll go ahead and add those. So I have a total in my allowance for bad debt of $2,990. And of course, don't forget your balance there. Bad debt. Once this has a debit. Oh. Ooh. We have. Just want to check because it does give us a balance. Nope. I see nothing. So, since there is a balance here, we're going to go ahead and put it at 0 just to be safe. And then the adjustment is the 1,590. Okay. And December 31st balance is 1,590. Check. Everything's good. Cool. That almost threw me for a little bit of a loop there. Having a balance right there. Alright. Climate 4 is now to show how Write-Top's Lifeholds will report net account receivable on balance sheet. So again, this is net realizable value. So this is our accounts receivable, which is 47,400. And we're going to subtract allowance for bad debts of 2,990. Again, 700 minus 2,990. My value is 44,410. Check. Okay. So, is there any questions over problem 1? Did y'all understand how the flow went? Okay. Alright. And again, for me, I can actually do similar questions. I can repeat these. They're fun. I can. Alright. Question 2. Again, looks like we got almost the same thing going on as I think it exactly is. Collections, write-offs. Look at the requirements. Alright, so this one's pretty much exactly like number 1. So really, I'm not going to go back over this one then, since it's exactly like number 1, except for a few number differences. I can tell that with the requirements. Because all you do is journalizing, requirement 1, just like we did. Then you post to the T accounts. Then you're going to do the estimate. Ooh, the estimate is on accounts receivable. So, this is the thing with this one. This one will care about what's in allowance for doubtful accounts. So, you know what? Why not? I'm going to do it real quick. Do the journal entries to get to that point so I can show you how that works. Cash. Again, since we've already done basically journal entries in the last one, I'm just going to go real quick through them so I can get to the point where it has changed. See, once y'all have lots of practice, you can do this too. Where test will not matter. Receivable, explanation, go, boom, here, getting the, this was 31,000, this was 4,000, then we should have print sales, collections, and then write-off. Sales was 156, collection, write-off, 20. Weird. Then okay, that was really quick. And now we have generalized Wendy's adjustment to record bad debt expense, assuming Wendy's estimate bad debt at 12% of accounts receivable. Post the adjustment to the appropriate T accounts. Again, always record debit first, then credit, and explain. So with this requirement 3, it's 12% of your accounts receivable. Currently, our accounts receivable is $53,700. And that will be our ending. So times 0.12. So, again, this is our ending balance of allowance for bad debt. So I gotta find, currently it's a credit, so all I have to do is subtract the unadjusted balance, and this should be my journal entry amount. Okay, again, always bad debt expense, allowance for bad debt, or the bad debt expense to be recorded under the allowance method. And there we go. Okay, so that is the tricky part of this question number 2, is requirement number 3 to do the 12% of accounts receivable. And then it's just basically, again, same as problem 1. So any questions of how I did requirement 3 on question 2? Okay. All right. Yes, I want to leave. I'm going to finish all that. Okay. Question 3 in itself is dealing with the third allowance method, which is, of course, the aging schedule, which is actually interesting on this one. So, again, we want to have our requirements. We then have click icon to view. Doesn't really give us anything there. Love how it does that. And really all we have to do is compute or calculate right now the age of accounts. Again, there's 3 parts to this. This is just requirement 1. So we need our calculator. Go ahead and do the total. 75,000 plus 45 plus 50 plus 40. Okay, about 210,000. Okay, next we would times by each of the percentages. Make sure, yeah, those are percentages. It just looks weird with a percent and diagonal. So 75,000 times 0.008. So that's 0.8%. Okay, this one's going to be 600 31 through 60, we have 45,000 times 0.02, 900. Okay. And we have 50,000 times 0.09 equals out to 4,500. And then lastly but not surely, over 90 days, it currently skyrockets in this book. About 40,000 times about 0.49. 19,600. Ooh, a lot of money even being uncollectible. Next, you'll add all of these, all the ones that you just multiplied. Sum list at 25,600. Okay, and check, make sure everything is good. Awesome sauce. Next, we're going to have to journalize the year-end adjusted entry for doubtful counts. Okay, so again, adjustment is still the same. Bad debt expense, allowance for bad debt, but remember, this is a receivable. This is our ending balance. So we have to look up here and watch this. It says that it currently shows a debit balance, 23,450. So if it's a debit balance, what am I going to do to the two numbers to find the adjustment? Should I add or should I subtract? Good job. Yeah, we add. We'll add the amounts when it's a debit balance. If it says credit, then you would subtract. Okay? I think we just did that just to mess with y'all and see if you want to subtract the two. So I have 23,450 plus 25,600. Means my adjustment should be 49,050. Again, y'all is going to be just a little bit different because y'all have different numbers, but the concept is still the same. Okay. And of course, always remember the explanation that I typically forget. There you go. Okay. That was a little trick of this problem. Everything, if you notice that it's a debit balance up here. Okay. Next is to show the actual T account or allowance for bad debt. I wish they kind of showed this one first and then have you do the journal entry so you can see. Of course, they want to be just slightly different. That'll be unadjusted balance, 23,450. Adjusted balance is the one from here. And then, of course, balance at the end will then our 25,600. So basically, right here, if it scrolls exactly like this, there's your ending balance, there's your adjustment, and then up here is your unadjusted balance. Alright. And then, of course, last part is we're going to show how to get to net accounts receivable, or again, net realizable value. I have to take your accounts receivable, less allowance. Allowance is already 25,600. And the account receivable balance is 210,000, which again we proved up here. So 210,000. Then all we do is subtract 2. Minus $25,600, $184,400. Check. Whoops. What's the next question? Go back. Alright. Any questions over question number 3? How many of y'all are actually trying to do the homework before I'm going over it? To be honest. Alright. So, when we get these days that we can kind of go over the homework, at least try to go over it or attempt it. So in case you do come up with questions, it's a little bit easier to go. Yep. Okay. Alright. Question 4. Alright. So question 4, I think is going to go over something. I don't know offhand what it's going over. Over your notes. We're going to find out. Okay? Again, we're going to record credit sales, ignoring the cost of goods. Okay. Now, only got this information. Now, we have a note going on. Is there a note? Okay. Close that back up. So, we have accounts receivable. This is all credit sales. It's not like before when we have cash along with it. So it's accounts receivable, sales, revenue. So 9,500, 9,500. Okay. And again, we're just recording credit sales. Okay. Next is the journal entry. We end up loaning $1,500 to Karen Price. That must be an executive with the company, okay, on a 1-year, 14% note. Okay, if y'all remember from the notes, we're recording a loan to the employee. Okay, what would be my debit? What would we debit for these? Our note. Okay. Okay. So, did any interest actually happen yet? No interest is yet. The note just started. So, we can't use interest yet. We'll use interest later on though. But, yeah, there you go, Tyler. I know you get it. It would have to be note receivable because we just wrote the note. Okay? So, what did we give up in exchange for the note to our employee? On AP receivables, they're gone. We haven't done interest yet. So, cash has to be the only option out of these. One thing I like about these drop-down menus, it helps to eliminate the choices very quick. So, 15,000 on each. Okay. Check. We're good. Move to the next. Now, here's our interest. We need to calculate interest again. So, what's the formula for interest? Okay. Alright. So, calculate interest. You have to take the principal of the note, which happens to be 1,500 for me. So again, it's going to be a different number. Then we multiply it by interest. So 0.14 for the interest rate. And then we times it by the fraction of the year. Okay? Now, again, since this is basically 1 year, it will be basically times 1. But I want y'all still get used to put into fractions of a year. Okay? So 12 divided by 12. So our interest is 2,100. Now, that's the complete interest. That's not what we're asking for though, are we? How much interest or how many months are in 2018 that we had? Because that was total interest, but we need to split this up. Almost, Alicia. Go ahead and add another one to that. And make sure on your check, go ahead and put it to everyone. Because I see a couple of y'all have it privately, means that I'm the only one seeing it. So, definitely make sure it's on to everyone. Okay? But, we'll figure, so, I cannot just take 1 month. Because look at when the note started. It started on November 1st. So I have November as complete month, and then I go to December 31st. So I actually have 2 months here. Okay? So that's why I can't use 1, because of when it started. So calculator, 2 divided by 12, or our fraction of the year, and our actual interest out of the 2,100. Because remember, that's total interest for the whole time frame. For 2018, it's only $350. This is also where they're trying to get you. Okay? So there's our numbers. Now we gotta input the account. So, here, since I'm dealing with interest, it will only either be interest receivable or interest revenue. Which of one of those will I debit? It will actually be receivable. I will debit. Remember, receivables increase by a debit. Okay? The revenue that we recognize is our credit, and we've earned that interest. Just haven't gotten paid for it yet. Okay? And that's our accrued. Okay? And then of course the explanation, blah blah. There we go. Always forget that explanation. It's not really used to putting it. Okay. There we go. Next, we're going to let basically the note. Okay? And they're saying single compound, just one journal entry. So here I'm going to skip the debit. Well, the debit in itself is cash, receiving cash. And the first credit that you're going to have is, of course, the note receivable. Remember, this is always the principal. So for me, that was $1,500. Next account is going to be the interest receivable of $350. Again, that's what we have up here. We're getting paid for it. Okay. Last one to credit is interest revenue. And again, we're recognizing the revenue that we have earned. But we need to figure out that number for 2019. Well, since I know the total is 2,100, all I need to do is subtract from the total, and boom, there it is, 1,750. Okay? The other way I can do it is doing the formula again. 15,000 times 0.14, our rates, then multiplying by the fraction of the year for 2019, which would have been 10 months divided by 12, which they both come out to the same number. This depends which way you go. You want to compute the higher interest and then subtract out the accrual, you do that. Or you can just do the fraction of the years. Both of them will work. So I still have to figure out how much cash did I receive. Well, all you do is take your credits and add them together. So 1,500 plus 350 plus 1,750. So the total cash I have received is 17,100. Okay. And then basically an explanation is collect note receivable plus interest. Check. Okay. Any questions regarding question number 4? Okay. So again, after we're done with everything, if you do have any questions and you want me to go back, I can definitely go back. Okay? Question number 5. Looks like we have another loan going on. So, boom. I'll look at this. Oh, we got a couple of loans going on. Even more fun. Let's go ahead and go right back over those one more time. So, this one right here again, I'm on a loan of $14,000 cash to Brett Doling for a 1-year 10% note. Hey, so which account am I going to debit? Remember, this is the receipt of the note. Note receivable, good. So we got a note receivable. And for me, again, this is $1,400 in cash. And then, of course, cash is an item that we basically gave them. I like how they got like 4 blanks just to mess with everyone. And there's gotta be more. So here we accepted a note in exchange for cash. Next, so we're doing these journal entries. We sold goods to Park Pro, receiving a 90-day 12% note for $9,000. I like how that actually tells me that what probably is going to be the differences between all the problems. And again, we're going more cost of goods sold. So, we got one here, this is months, and this is going to be in days. So we're going to have to watch out on those. Alright. So again, there was some trouble. This is still a note because we got interest coming. But what would be the credit this time? So think about what we exchanged the note for. Or what action did we do on this one? This time we're going to credit the good old sales revenue. Okay? Because we sold goods. Okay? So instead of selling goods on account, we gave them a note with interest. And it's still going to be the principal. Okay? And the explanations, there we go. Sold goods for a note. So for this one, we're going to June 30th. Alright, this is interesting. They made a single entry to accrued interest revenue on both notes. Use months for 1 year, and of course 365. So it's already let us know. This is round to the nearest cent. Alright. So, this one's going to take a little bit of time to do. So this is June 30th. So we're going from April to June on the first note. So, how many months would it take me to get to June 30th? Three. Good. We have the whole month of April, whole month of May, and then the whole month of June. So see, we have only 3 months. So again, to calculate the interest being accrued on June 30th, we would have to take the 3 months and divide by 12. Okay? Again, take your principal times your interest rate times the fraction of a year. Alright, just happens to be 350 again. I think that was just luck. So that's only one note. Okay? Next, we need to figure out the interest on this note. This started on June 6th. So how many days will it take from June 6th to get to June 30th? Yeah, simple enough with 24. 30 minus 6. So I have to do the same thing. Principal times rate, 0.12 for me, times the fraction of the year. Since I'm working in days, I have to keep it to 365 as my denominator. Okay? So this one has a long decimal, but it does say round to the nearest cent. So for me, I've been $71 and a penny. So the 3 will round it down. Plus the first note of 350 would mean my total interest will be $421 and a penny. Okay? So again, you have to figure out the total interest. So I did not I did not get paid for the interest yet. So again, still interest receivable. And what would have been the credit? Almost. Credit will be the revenue. Okay? This is week earned. So debit receive, credit revenue. Okay? Again, this is our accrual. We'll check and everything is good. So watch out with this one because they want you to basically combine the interest on both notes. Okay? Now, we're going to do the maturity for each one. And this is fine and dandy with the Park Pro note. Since it was 90 days and starting on June 6th, that means it's going to finish within this year. Because again, it's still 90 days. Problem is that they want you to figure out when does it mature. So, here we go. We already know that it's going to take 24 days to get to June 30th. Okay? So that's how many days that we still have after June 30th. Well, we have July. How many days are in July? 31. Got caught there. So, 31 days. Then we gotta look at August. August also has 31 days. Okay? Meaning we have 4 days left. So, that means it should end on September 4th. Okay? This probably wants you to calculate the mature date. So that's going to probably change sometimes the date on y'all. If it does, it does. If it doesn't, it's okay. As long as you know how to get to the mature date. Remember, the exam probably going to have that. Alright. So, we're going to collect the maturity value, or basically the note. So again, this means we're going to receive the cash. Okay? This also means that his note receivable is being closed out for Park Pro. And also interest receivable. And of course we have to record interest revenue for the current period, what happened after June 30th. Alright, so again, we can fill out the stuff we know. The note was for $9,000. Again, that's going to be a credit since he's paying it off. Interest, we figured out using our calculator. That was $71.01. Okay? So, the last thing we have to do is compute the revenue. And look at this. While I was computing the maturity date, I actually figured out how many days left are on the note after June 30th. That would be 66 days. So again, let's just go ahead and do the formula. 9,000 times our percent rates, which was 12% for me, times 66 days, which is the remaining days of the note, divided by 365 for the year. So, for me, my interest remaining is $195 and up 29 cents. Okay? Again, round to the nearest cent. So, for cash, I received the 9,000 plus the 71 and a penny plus 195.29, the current interest for the current period. So I should have overall about 9,266.30. And this is a collection note. Okay? And I'm going to check, and everything is fine. Now we have to collect the mature value of the dowling note. So the same thing going on. Cash, note receivable, and that's my credit since it's getting paid off. Interest receivable, and interest revenue, and of course collection on note with explanation. So note receivable for dowling was $14,000. Using the information to calculate the interest was $350. So that was prior And remember, we said that was 3 months of interest. So how much interest is still left if this was a 1-year note? How many more months do I have to calculate for my interest for this current period's revenue? Yep, 9 more months. Since this was a 1-year note, that basically breaks down to 12 months. Since I've already calculated 3 months, all I got left is 9. So 9 divided by 12 would mean for me, I have interest of 1,050. Okay? And then again, you can add everything up. 1,400 plus 350 plus 1,050 equal 15,400. Okay? Check. We're good. Okay? So question 5, really the only difference between question 4 and question 5 was that you have 2 notes that you had to deal with, a combined interest, and then days for Part Pro or your second note, as it was in 90 days, while the other one was in months. Any questions regarding question 5? Okay. This is slowly starting to feel a little bit easier, huh? Somewhat. I bet. Alright. Question 6. Question 6 is our good old ratios. Okay? So we're kind of going to need this little chart. Of course, I can't put it anywhere if I'm looking at the chat at the same time. Oh, I want to sit right now. Alright. So we want to calculate the asset test ratio for 2018 round to 2 decimal places. Okay? Determine whether their asset test ratio improved or deteriorated from 2017 to 2018. How does their asset test compare to the industry? Okay. So, going over the ratios, show in the chat. Let me do it that way. There we go. That's a little bit easier. Alright. So, asset test. We have to know the formula, which is this long line cash plus short-term investments plus net current receivables, again divided by the average. If you ever need help with these formulas, again remember, it's current liability, my bad. That one's average. Again, even I can't remember all of them. So, always check the notes form the formulas. Oops. There we go. Current liabilities. Make sure. Yep, current receivables, short term, and cash equivalents. Yeah. Okay. So now we gotta figure these out. So using our data table, we find cash happens to be 2,500. So 2,500 plus short-term investments, and I'm doing 2018, which was 20,000, plus net current receivables. Okay, I think 272,000. That's a little bit interesting. All right, let's see if we get this. So that is our current, but net of fees. So why wouldn't it be just 272,000? You know what? I'm just going to think. Basically, it should be 272,000 if I'm thinking it right. That formula's weird. Alright, so let's just take 272 since that is your complete receivables. Again, cash and if they're doing net, it would be subtracting these two out of the total, which still ends up being the total. Okay, just gonna go with it. We'll add them all together. And divide by total current liabilities. Something just feels weird. I'm gonna go with this one. 2001 check mark. Okay, it doesn't like that. It has to be 294,500. Plus net current receivables. Oh, guys, I am kind of dumb on this one. That is my bad. You know how bad I am? I'm adding all the current assets. I'm thinking current assets. That's receivables. No, what I was thinking. Alright, so it's only these three in the column. 2,500, 20,000, 54,500. Oh, what was going on? That is a complete brain killer there. So 77,000 divided by 1. So 0.69%. Alright, so really this part is just the first three numbers. For some reason, I was going for the whole current assets. I was doing the current ratio. My brain was just not working properly right here. So all it is cash plus short term plus the net of accounts receivable. So basically, if you look at these three numbers, that's your accounts receivable minus allowance for bad debts. I just wasn't thinking clearly for some reason. So like for 2017, it's going to be the cash plus short term, 9,000, plus the net of accounts receivable, which is just basically our AR minus allowance for bad debts, or what they've already figured out means 68,500. I don't know why I wasn't getting that correctly. 86,000, and then divide by current liabilities. Okay. 0.76. Okay. So all it was is somehow my brain did not want to function correctly. Sometimes this happens. Again, for a human. My brain saw receivables. I was thinking assets for some reason. Net current assets. That's what was throwing me off. But in reality, it is just receivables plus net receivables plus your short-term investments plus cash. Alright, sorry about that. Okay. So the asset test ratio from 2017 to 2018. Basically, if we went from this period to this period, did it happen to improve or deteriorate? Basically, decrease. For me, it indeed pretty much decreased. Percentage went down, or the decimal went down. The company's asset test ratio is linked to the industry average of 0.8. It's going to be a little bit worse then. Okay? So again, on this one, when it pops up, just saying compare. Remember, this is 17, and you're going to 18. So did it do better? Did it do worse? And then you compare to 0.8. Okay? So again, they'll give you three options. Is it the same? Is it better than what the industry average is? Or is it less than? Okay. Alright. Required 2 is now our accounts receivable turnover ratio. Okay. So, checking back our notes. This states that net credit sales divided by average accounts receivable. So there's our formula. Net credit sales divided by average net accounts receivable. So check. Yeah. It's average accounts receivable, but they gave us average net. So that thing is that it's an average. Okay? So this says net sales all on account. Okay. So all of this is credit sales. Okay, so for 2018, we already know that number. Now it's time to figure out average net accounts receivable. So all this is doing is taking your 2018 and add the 2017. Okay? Then divide by 2. So it happens to be 61,500 for me. Okay? And then I would divide the two numbers. And again, round to 2 decimals. So 707, 250, divided by 61,500. Oh, not bad. 11.5. I didn't even have to do 2 decimal places. That's our ratio right there. So again, net credit sales divided by your average. So for this one, you have to figure out the average. And then we want to see the company's accounts receivable turnover ratio is blank the industry average of 10. Again, there's your equal, there's your less than. So we're not less than 10, we're actually greater. We're better than the industry average. Okay? And then the last one is our days sales. So days sales, I know, is 365. So it's basically how many days divided by our turnover ratio. Again, you can always check your notes. Have the formulas right there. There it is, 365 divided by the turnover ratio. So don't need this anymore because these numbers are already given to us. So 365. Our account receivable turnover ratio is up here, 11.5. I'm going to put 50 just for 2 decimal places. And now it's just calculate. So 365 divided by our ratio. Again, they want to do the days in receivables to the nearest whole day. Okay? Income calculations are 2 decimal, but everything else is whole day. So this will mean I'll round to the wholest number as 31.7. So I'll round this up to the next day. So it's about 32 days. Check. Good. So be careful of the rounding. Okay. So their days in sales calculated based on their credit period is worse. It takes more days to receive the money than what the credit history period is. So 2 more days than. So it is worse than. We want it to be under the credit period. Okay? And that is the last question. Okay? Any questions over the ratios? Besides me messing up the first one. Okay. Well, that's going to conclude for today. So if you have questions over any of the homework questions, you're feel free to ask them. But if not, you're good to go for today. So I will see y'all on Tuesday to go over Chapter 9. Again, got plenty of time to basically answer this. It's not due till the end of the semester. But since we went over it already, hopefully you got most of it filled out, or at least know how to. Go ahead and just knock it out this weekend. Okay. Better knock it out soon than procrastinate and then you rush through it and mess up. Again, if you're ready to go, you can go ahead and head out.